Hello, income investors. It's great to have you back again on this channel. Today, I'm going to talk about an ETF called BIGY. The name sounds fancy. It's basically the large, tech firms, just like the FANG or the Big Seven list. Previously, we talked about CANI, which is the large companies in Canada, and that was an ETF of similar format. And this is also known as the Evolve US Equity UltraYield ETF. This focuses on the large US companies. And I'm going to talk about this fund, which is pretty new. At the same time, I'm also going to compare it with another fund, which is close to hitting its 1 year mark. And also look at the various aspects like dividend yield, capital appreciation, the portfolio, etc. So stay tuned till then to know more and to understand whether it's a good for income investor or it's for a pure growth oriented investor or can it be a combination of both. So stay tuned. So before I move ahead, just wanted to give you a quick disclaimer. This video is not sponsored or endorsed by me to promote this fund. So it can be clear that this is my own personal experience or opinion based on my own study, and I've not personally invested in this fund so far, but I've just done my initial research. Uh, the fund ticker symbol is BIGY, which is called the Big Y or Biggie. The name is Evolved US Equity UltraYield ETF. It's basically a high income generating fund. Uh, you know, Based on the portfolio of certain large US companies. You see that on your screen. Strategy, the Amazon, the Palantir, Apple, Microsoft, Coinbase, Alphabet, Meta, Nvidia, and Tesla. So all the big tech names that you're familiar with, and all the some of them are cryptocurrency companies, or some of them are large, electric vehicle or media companies that you're familiar with. Okay, what's so special about this fund? Like that's the question that comes to mind. Yes, you have this portfolio of all these high growth companies, interesting companies, the big 7 or 8 US companies, more tech focused, more growth focused. Uh, High monthly income is what is attracting people to this fund. Plus, there is a high growth aspect to it as well. Uh, so let us look at the fund, you know, step by step. There are two aspects to it. One is the equity income with some leverage. That's what is mentioned here, plus leverage. And distributions are paid twice a month. So if I, you know, go down a little bit, I will know the details of that. So Big Y invests in leading US companies and employs a covered call strategy on 50% of the portfolio. And this is a common strategy that we see in many of the funds, whether you look at the Canadian HHIS or the CANI fund. You find a similar kind of setup where they write calls on half of the portfolio. The remaining half is open for unlimited upside. So that's a great strategy that is working for many of the funds, and investors also like that aspect. I would not say that that's the best strategy, but that's a balance of income plus growth aspect packaged into the same fund. And this one ticket solution delivers cash distributions twice a month for more frequent investor cash flow. That's a good news for uh, many income investors who are looking for cash flows or regular distributions. Usually it's monthly distribution. In this case, you have like twice a month, probably once in the middle of the month and once at the end of the month. And yeah, so the basic information is on your screen, like the fund details. The ticker is Biggie. We have that on the left, and it's listed on the Toronto Stock Exchange. The fund was started in September 2025, very recent, hardly 2 or 3 months now. 3 months now. So I would not, you know, uh, recommend anyone to jump into this fund at this stage. Observe the performance and see how it goes, and then you take a call on that. Management fees 0.4%, which is reasonable. Distribution twice a month, and distribution amount per unit has been given here. It's about 0.3120. Looks pretty interesting, like on the surface, like when you look at the basic information. And here they say that the leverage is going to be 1.33x, which means 33% leverage is going to be used. It's an actively managed fund with a covered call strategy with 33% leverage. You can see that on the left side of your screen in the middle under the style where it says it's an actively managed covered call fund and it uses 33% leverage. So about 33% they borrow, and that helps the fund to enhance the returns as well as to increase the exposure to the stock so that you get more returns in terms of growth plus in terms of the income. So that's about this fund so far. Like it's fairly new, so it's too early to comment on the dividend yield as of now. Let me look at the performance part of it. Yeah, we don't have much information on that. Let's look at the portfolio. Like the portfolio is entirely United States, and you have a mix of technology, communications, consumer, cyclical, and financial companies. The majority is into technology and communication side. Just drop down a little bit to see the mix of the portfolio. So majority of the portfolio is into these big names: Alphabet, Tesla, Apple, Nvidia, Palantir, Microsoft, all the big blue chip companies in the tech space, and we are familiar with all these companies. Coinbase is, crypto-oriented platform, so it's a financial category in terms of the sector. Meta Platforms communications, Amazon communications. So you have a mix of all these different types of technology companies. Like within the technology, you have various subsectors. Strategies again oriented, and you have all these call options written on the same companies. So roughly, you have around 1 to 10 companies, and the rest would be the options written on those holdings, which is used for generating income. Like you can see they have call options on Nvidia, Strategy, Palantir, and so on. So you can go through this holding section in the website Evolve ETFs, and you will find more information on that. I wanted to quickly show you another thing which I missed initially. So when you look at the page which talks about these two funds, you will find they come under one category called Ultra Yield Funds. Evolve US Equity UltraYield Funds, and you find two products. Like when you look at the left side on the top, when I get into the products menu, you see that Ultra Yield. You have two, the biggie one, Evolve US Equity UltraYield Fund, and the CANI one, the Evolve Canadian Equity UltraYield ETF. So one is Canadian, one is US. Just that's a simple way to put it. And both come under the ultra yield category, because which means you're getting enhanced amount of yield or higher amount of income from these funds. And this is what we have so far. And let's look at the distributions. So the distributions start in September 2025, September 29. Okay, payment date is October 5, and then you have every 14 days you get some amount of dividend. October 22, you have another 31 cents, and every month it's roughly 31 cents. Uh, let's assume this run rate of dividends is maintained. So if this is maintained, what would be the dividend yield? Again, this is speculation. Like I don't know if the dividends are going to be maintained or not, and this is not a recommendation to invest or uh, any financial advice here. You should do your own due diligence and take your own decision. But just for the curiosity, I'm going to do a quick, math here. So we have like two payments every month. So that would be 12 times 2, 24 payments for the whole year. And imagine that each payment is maintained at 31 cents, 0.3125. So that works out to $7.50. So keep that at the back of your mind, $7.50. Now let's look at the fund price. Okay, currently it's $23.89, okay, as per the chart. So this can go up and down. So let's take this number for now. So 7.5, 23.89. 7.5 is the dividend and divided by 23.89. And you have a whopping 31.39, roughly 31.3% yield in terms of the distributions. And most of the distributions are earned in the form of premiums. So that is the amount they are distributing. That's a very high amount of dividend yield. We are not even counting the capital appreciation here. But I feel there might be a little bit of erosion on the capital front because of the high distribution. Let's look at what is the price of the fund since the beginning or since the fund was launched. When you look at that one, okay, this is EVMAX, this is not. If you look at the BIGY, okay, starts from September, okay, 25 to 23.89, okay, okay. So on one hand, we have just opening my notepad for a quick notes. So on one hand, we have dividend yield of say 31.3, 31.39%. And let's look at the other side, like 25, 23.89 minus 25 is the price at which it was launched and divided by 25 times 100. Basically, the fund lost 4.44% on its capital or on its net asset value. So, which means we are losing on the NAV about 4.40%. Yeah, I'm just explaining this because there was a comment or request from some people that how do you calculate the yield and total return? So I'm just explaining that part. So this would be minus because you're on the negative side, it's gone down. So minus 4.4 plus 31.39, 26.95. So to total you have 26.95 in terms of the total returns. Even if you take it as 26 or 27, it's still a great amount of returns that you're making on this ETF. I would say if it's able to maintain its NAV almost like steady, you're not losing more than 5%. You're still getting a good amount of yield. And let the fund complete 1 year, then we will get the right numbers, the right picture. But right now it's too early. We are just speculating. And this is only 3 months so far. Let's look at how the fund performance performs over the next 9 months. And once it reaches the 1 year period, we'll know the correct picture. So this is one fund that you can, look at in future and look at the performance and then see if you want to, take an exposure to it. And I'm looking at another fund. Like I'm going to show you that as well on your screen. The other fund, which is similar to this, is called the Tech Innovators shares. This is from the Purpose Investments. Pretty interesting, same kind of concept. They have nice fancy names also. Uh, so if you see, look at the purpose of the fund. I'm going to zoom it here a little bit. Maximize yield by investing in a portfolio of technology and innovation companies using covered call strategy. Pretty interesting. And gain exposure to the tech's elite club, including Broadcom, Alphabet, Tesla, Meta, Microsoft, Amazon, Apple, and Nvidia. So it's basically BATMMAAN. So they are calling it as Batman, BATMMAAN. Interesting. Broadcom, Alphabet, Tesla, Meta, Microsoft, Amazon, Apple, and Nvidia. So they've kind of interesting acronym for that. Pretty interesting. And then The strategy is more or less similar. 3% of the portfolio I would call strategy, and then there's a leverage which is moderate. In Evolve, it was 33%. Purpose is doing only 25%. So it's a lesser amount of leverage. So this would be suitable for someone who is comfortable with lower amount of leverage, less risky compared to the Evolve one. And yeah, you have the distribution number here. It's 20 cents per month. Okay, I'll go through this also one by one. We look at the portfolio breakdown. So here you can see the stocks basically: AMD, Netflix, Shopify, Broadcom, Coinbase. Okay, the interesting fact here is, despite the name Batman and all that, they have added other names to the portfolio. It's going to change. So they have added Shopify. They have added some newer names. Like, as I can see that here, it's not just the Batman ones. There's a Shopify. There is AMD. There's a bit of change here, but the theme is more or less similar: high growth and high tech companies. And when I look at the distributions, they have given good amount of information about the covered calls. So how many calls they are writing and how much in the money or at the money. You can look at this section if you're interested into that, statistics. But I'm going to go into the performance and distributions part. So if you look at the distributions, it's been pretty steady. Like, we know it's 20 cents, but I'm just looking at the past months to see where we are. Every month it has been consistent, 20 cents a month. And it started back in paying in March, February, March. So it's basically 10 months. Assuming the same trend continues for another 2 months. So they complete 2 years, sorry, 1 year in January, somewhere around January. The fund was launched in January 2025, if I'm not wrong. Just do a quick check on that. Yes, end of January 2025. So by end of December probably, they'll be hitting the 1 year mark. And let me do a quick math here to see where it is. I'll just compare the dividend yield for now. So if we take 20 cents times 12, we have 2.4 divided by 2389. It's roughly 10% yield, 10.04, roughly 10% yield on the dividend front. Okay, 10% yield on the dividend side. I don't have the information about the price right now, but it looks like the NAV has been steady so far. It's too early to say anything. I would say this is another fund to look at if you are looking at BIGY. You can compare these two and see which one is more suitable for your needs. We are looking at a lower amount of leverage, or you want a higher amount of leverage, or you're looking at a bi-weekly distribution, or you're okay with the monthly distribution. So all those things factor into the decision making. So once this hits 1 year, you can compare the two, and also wait for Biggie to also hit close to at least 8 9 months, so you get a full clarity on where it stands. So overall, I would say Biggie is a good option to consider in future going back to the fund again, uh, you are going to get a mix of high amount of um, distributions because it's almost like 30% plus. We don't know whether that 30% will sustain. It may reduce to 25, 20% in terms of the distribution or dividend yield. But if you look at the capital appreciation too, it's pretty decent so far. I hope if the tech sector and the markets, go in the positive direction, then BIGY can be a great option to look at if the fund performs well and if the choice of stocks and the portfolio does well in the future. So for someone who is comfortable with the high amount of leverage, like if you have 33% leverage, it's mentioned here, like when the stocks go down, you're going to go down by another 33% more in terms of momentum. So you're going to lose a little more. So if a stock falls down by 10%, let's say the fund falls by 10%, you're going to, you know, get an impact of around 13.33% because of the leverage factor. So that's the risk that you need to be cognizant of. If you're able to stomach that risk, this fund is a good option to look at. But if you're looking for a lower risk option, probably the other fund, the Tech Innovators Fund is another one to consider. Probably if you're looking for a lower leverage. But if you're looking for a further down on the lower risk spectrum, then probably you have to look at funds which do not have leverage. Or you have to look at funds like HHIS from Harvest, which have leverage, but you not only have technology stocks, but you also have other types of stocks which are in the Nasdaqs. It could be, Costco and other retail and other types of stocks packaged into the same fund. So that's another option. Or look at funds without leverage. So, so these are the things that I wanted to share with you. And since this is a new fund, I'm not going deeper into Biggie because I also want to observe that and not provide any early information which may not be correct or which may not be thoroughly researched. And if you like this video and if you liked what you're watching, please feel free to subscribe to the channel and to show your support, you can like or you can even drop in any questions or comments you have. We will try to answer that. Thanks a lot. Have a great day.